Absolutely. Jeff, let me congratulate you with this fantastic win by the Lionesses. And I think all of Europe, even the world, has been enjoying that epic match last night. And indeed, as a proud sponsor, Heineken, really enjoyed the tournament. And there was a sliver of orange there because I believe the coach of the English women's team is actually Dutch.
Absolutely, and she did a fantastic job, clearly. So just focusing back on the numbers, a 22.3% jump in first half net profit, boosted by growth in beer volume. Customers then clearly going back to the bars and the clubs here. But the outlook seems a little bit muted. Why is your outlook less positive given what you've delivered in these numbers?
Indeed. Now, thanks for referencing, the overall results. We are very, very happy and encouraged by the results, both top line and bottom line. Indeed, very solid beer volume growth. I think it's testimony to the resiliency of the beer category, as well as our footprint and our brand portfolio all over the world. We're up in volume in all 4 regions. Importantly, our volumes are now up in regions versus 2019. Revenue up over 24%, and indeed operating profit also up over 24%, driven by assertive pricing and our productivity program. So very happy with this result. So far, consumers very resilient, as our volumes are testimony of. But indeed, the kind of pricing we and others are taking is unprecedented, and therefore we rather be cautious and vigilant in the near term, and therefore that outlook as we shared it.
Indeed, you say that so far consumers have been resilient, but obviously they're facing massive price pressures, as are you, Dolf. And I see here that you've shelved your margin target for 2023 because of those cost pressures. What is your biggest cost problem, and is it within your control to be able to mitigate it? What can you do, and what is out of your control?
Yeah, maybe first let me clarify that outlook. We have reconfirmed our margin guidance for this year, 2022, flat to slightly up. We have adapted our guidance for next year, moving from an operating margin guidance to an operating profit absolute growth guidance. And the reason is that with the kind of pricing we are taking, our revenue per hectoliter was up 15.6% in the first half. You kind of get a nominator-denominator issue, where anything expressed as a ratio is kind of under pressure. And that's why we prefer to guide on absolute operating profit growth, and we're guiding mid to high single-digit operating profit growth for next year, which is still considerable, I would say.